Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with our top story. Hot US data pushing out rate cuts. The Fed's preferred inflation gauge due on Friday. Michael O'Rourke of JonesTrading saying this: financial markets are at an inflection point. The Fed's overestimation and overconfidence as to how restrictive policy is has fueled easy financial conditions and excessive risk-taking while fostering easing expectations. Michael joins us now for more. So, Michael, bearish. Fair to say based on that?
Yes, definitely fair to say. I mean, I think you've touched it. Even when you talk about that 10-year yield potentially going to 5%. Right now, for the past 3 weeks, the 10-year yield has been higher than the S&P 500 earnings yield. Even though the S&P 500 has corrected 6% over that time, that relationship has stayed the same because yields have continued to rise. And that just shows you have a risk-free instrument offering you a very attractive return versus risky instruments in equities that are pretty expensive.
Drawdown so far, 5% from the all-time highs of March. How much downside are you looking for?
I think there's a lot of potential. I'm not going to sit there and say, I can't put a number on it because a lot of it's driven by financial conditions, right? We've had this easy financial condition environment that has basically fostered equity prices, fostered asset prices across the board. Even the Fed's financial stability report released on Friday talked about how equity valuations are high, historically high, how credit spreads are tight. But if that relationship between treasury yields and earnings yields, it's traditionally the equity, the S&P 500 earnings yield over the 7 years prior to the pandemic was about average 340 basis points over treasury yields. Even to just get a third of that back, the S&P 500 would drop 20%. And that's the type of risk we're talking about here, that I'm not saying we're going right back to that relationship. It just gives you an idea of how expensive stocks are relative to bonds.
I love this. Everyone who comes on the show today seems to think we're at an inflection point. Bob Michael also seeing a potential inflection point, but in the opposite direction,
yes.
A potential opportunity to buy. Why is this inflection point, in your view, going to inflect more negatively?
Well, because, you look at the earnings situation. We have earnings season come up. We're talking about all the big earnings this week, right? Earnings this quarter is supposed to be basically sequentially flat versus Q4, almost flat year over year. The big bump in earnings is supposed to come in Q2, 3, and 4, where aggregate earnings are supposed to rise 16%. Now, analysts are forecasting a 16% earnings jump for those 3 quarters in a 5.375% Fed funds environment. We're not getting the rate cuts we expected. We're not getting what the catalyst that should drive things going forward in the economy. We've had an incredibly strong economy, and a lot of that is fiscal and monetary stimulus from the pandemic playing out over the past couple of years. So again, to expect that type of jump in earnings, it's pretty aggressive. And if you don't get that, then you realize how expensive this tape is.
And do you see this idea of a sell-off in stocks that comes along with an ongoing sell-off in bonds, sort of something that continues the divergence that you were talking about with the 10-year Treasury yield being above the S&P 500 earnings yield? Yeah,
well, if you go back to the 90s and probably the earlier 2000s, the old saying was, stocks follow bonds, right? If Treasury yields were coming down that big bond bull market, stocks rallied, right? Because they're competing with each other for assets, for investment assets. So now we're seeing Treasury yields rise, and basically, which means bonds are going down, and stocks should be following bonds lower here from a price perspective to keep that earnings yield for the S&P 500 somewhat competitive with the risk-free instrument in Treasuries. And we just haven't really seen that yet, except in the last 3 weeks we've seen this dip, but they've moved together. Do any of these relationships still stand, or have we broken all of these? No, well, so that's the interesting thing. If you go back to late 90s, the Treasury yield was the earnings S&P 500 earnings yield was consistently lower than the Treasury yield, but that was during the Great Moderation as inflation was coming down for basically decades at that point, and bonds were just cautious, or investors were late to follow. This is the inverse situation where we're seeing inflation's more sticky. We're seeing a structurally different economy than we've seen from 2000 to 2020.
You say that the Fed policy does not need to change at this point, but communication does. What are they getting wrong when they're speaking to the market?
Well, I think they're just taking what they're seeing in front of them, and they're being overconfident in what they're seeing. So in 2021, the story was it's transitory, and we heard that for a year. When the Fed finally raised interest rates, core PCE had actually peaked in February of 2022. The Fed raised rates in March, and they finally ended QE in March. They were late, and they were too confident for too long. So since last summer, we've heard policy is restrictive, but it hasn't been. In Q3, we put up a 5% GDP print. At that point, the Fed has to go back to themselves and say, we're missing something in this economy. And instead of doing that, they continue to say policy is restrictive, and they keep this estimate of the long-term Fed funds rate down at 2.5%, which is only a 50 basis point, real neutral rate, whereas even the New York Fed's DSG model has it at 2%. So they're basically going off of a forecast that interest rates are going back to lower levels, or the market's taking their forecast. They don't actually even believe it anymore, and saying, oh, this is where we're going in the future, so we can keep equity valuations inflated a little bit higher.
We start hearing some Fed officials talk about whether or not they are actually restrictive, though. And Michelle Bowman last week said, we're restrictive, but we might not be sufficiently restrictive. What's the difference?
Oh, it's massive, because if you're underestimating or if you're overestimating how restrictive you are, then you're making a policy mistake, because policy is far looser than you believe it to be. So that is why, over the past 3 quarters, if you include what this Q1 is going to look like, we've put up, I think we've averaged GDP of about 3.6%, which is double the Fed's long-term forecast of U.S. potential GDP. It's funny, Chairman Powell talks about the risks being imbalanced now. If you go back to pre-pandemic, when we had 1.8% core PCE, the Fed was willing to do anything to push inflation up to 2% and micromanage it there. Here we're at 2.8% PCE. We're talking about things being imbalanced. Meanwhile, the unemployment rate's 3.8%, which is 30 basis points lower than the Fed's long-term target of 4.1%. So we're still in an inflationary environment per the guidance they give, per their models, per their forecasts. But they don't talk about like that. All they've talked about for the past 6 months is cutting rates until the past couple of weeks.
So why should I just buy stocks? There's no sign of them hiking anytime soon. Growth is good, inflation's sticky, top line growth's going to be solid off the back of that. Why wouldn't I be a buyer here?
Well, it's funny. I know when you guys had Torsten Slotkin and Tom Keene talks about it's a GDP-driven event.
Sure.
And he is right about that. And that is something I agree with. I think the risk here is we've had so many people chasing these rate cuts, chasing these higher valuations, that I think we're due for that correction at this point, as long as these Treasury yields continue to rise. If Treasury yields stabilize here, I'll start to reevaluate. But once that risk-free instrument starts to become more attractive, I think you're due for an equity correction.
Very close to 5% this morning on a 2-year, 498.64. Michael, enjoyed it. It's good to see you.
Thank you.
It's been too long. It's like years in person since we've done this. Michael O'Rourke there. Thank you, sir. Tasnim Ghiawadwala, following the impact of those and more at Citi, Commercial Bank, and Tasnim, I'm pleased to say, joins us now for more. Tasnim, wonderful to catch up with you. I can just say a little bit about our travels. We've just got back to New York from Washington, D.C. We spent a week, we thought we were going to spend a week at least, talking about the economy, and what we met was a load of economists who were national security experts. Now, Tasnim, I just wonder from your perspective whether you can speak to some of the trends that you've seen evolve that might speak to that, the worries over what's happening between China and the US and maybe other countries too.
Yes, of course. Thank you. Firstly, thank you very much for having me. It's a real pleasure to be here. Definitely we are seeing a lot of activity with our clients as they try to navigate the environment, which just seems to be getting more and more intense on the macros around inflation, around interest rates, which are proving to be, definitely higher for longer, and clients eagerly awaiting when the cuts cuts are finally going to come. But, as you just mentioned, on the political side as well, lots of things for our clients to navigate.
Tasnim, how much has this actually altered the view for mergers and acquisitions? We were speaking with Bank of America's CEO, Brian Moynihan, and he said it's very difficult for companies to get any conviction to buy another company or merge at a time where a lot of things are being rejected in the name of national security concerns, in the name of antitrust, the name of whatever. You can't predict it. Are you seeing the same thing among your clients?
Yeah, it is a very, very difficult time on the deal front for companies to go about. Although we are seeing some deals close, we've had some sell side opportunities at Citi, and some of our clients have been able to go through the cycle. But lots of things in the way, exactly as you mentioned, and also with the high interest rates, capital to fund the acquisitions are also, another factor that is proving to be a sticking point for our clients, that, it's not cheap anymore to buy another company. You've got to, make sure that it's really worth it, that the valuation, you're not going to overpay, and the valuations are going to be there to see you through kind of the medium and the long term.
Tasnim, a lot of people are talking about this week as a pivot point. We're going to get the earnings of 178 of the S&P 500 companies. You focus on a whole host of smaller banks and smaller companies that have individual challenges and might have an even better view in terms of the direction of travel of both economic strength and inflation. Are the signs that you're seeing consistent with this general feeling that we're going to get a no landing with inflation that's going to run hot for the foreseeable future?
So, I think one of the things that I think is interesting that we're seeing with our clients is that their balance sheets are actually really, really quite strong. For the vast majority of our clients, we've been supporting them as they think about diversifying. Although the environment is very tough, I think it's also posing quite a lot of opportunities for clients as well. They're really thinking very, very strongly about their supply chains and how they make them more resilient, how they secure, make them very, very secure as well. And I think, things like nearshoring, things like diversifying the funding environment for our supply chain. I think these are the opportunities that our clients are kind of playing into. So I think it's not all doom and gloom, quite frankly, where our clients are concerned.
Is that nearshoring due to the market or because of policies and, this urge by certain governments?
I think it's a bit of both. I think, on the supply chain side, I think clients are trying to address things like logistic costs, like ensuring that, their goods actually get there, there's no delays, and manage it from a kind of a cost and a security. And then, of course, there's the incentives as well. Last week I was in Mexico, where I actually saw the whole phenomena of nearshoring, like with my own eyes. It was quite amazing how, when large companies, the big MNCs, announce either a new investment or an expansion of a factory, like in Mexico, the entire supply chain kind of follows them there, and a whole kind of ecosystem gets built out around those large suppliers, like, Kia announcing the big expansion of its plant in Mexico for EV cars. There's a whole kind of tier 1, tier 2, tier 3 impact around the supply chain with that.
Do you see Chinese firms moving into Mexico? Because that's been a big concern with lawmakers and officials in the United States.
There are a couple of Chinese firms, but I think it's wider than that. We've seen Korean firms as well. We've seen other Asian companies moving there as well. So I think it's more mixed. I think there's, what we're noticing with these kind of corridors is there's a big North Asia to LATAM corridor that is very, very vibrant. And it's not only into Mexico as well, it's also into Brazil and other LATAM countries as well.
Tasnim, what it sounds like is for multinationals it's becoming increasingly complex, and it might lead you to believe that perhaps they'd just stay local and avoid expanding beyond their own borders. You're not seeing that, are you? That's not what I hear.
Absolutely not. Of course, companies want to make sure that they're strong, in their domestic and markets, and they're operating very well. But I think, the vast majority of our clients, and the reason they come to Citi is because they have global ambitions. And so, as they think about how they're going to grow themselves and how they're going to succeed in the market, that, more and more our clients are looking at cross-border opportunities as the way in which they are going to grow and access new markets. And that's where, a bank like ours can really help them.
Can we just talk about, just finally, how that growth is being funded with interest rates near multi-decade highs in some regions, including here in the United States? Are the sources of funding shifting, Tasnim? Have you noticed that?
Definitely. So I think one of the first things I'm going to say with such high interest rates for quite some time now is that clients are really getting absolutely focused on their own liquidity and looking at any kind of trapped cash that they may have, looking at very sophisticated, even mid-market clients that, probably didn't pay that much attention as closely to their liquidity as, say, some of the very large clients would traditionally be doing. They're paying a lot of attention to ensuring that they're efficiently using all the sources of capital, that payments are like SWIFT, their collections are really quick as well, and that whole cash conversion cycle is as tight and as efficient as possible. And of course, we've got lots of solutions that can help with that. But I think there's other pools of capital, of course, as bank funding, and then we're also seeing the rise of private credit as well, as coming up as being a kind of complementary to bank funding for these clients. So lots and lots of kind of innovation happening on the financing side.
Has that innovation led to basically an environment where higher rates have not crimped the expansion plans of a lot of these companies? Even though it might be more challenging, you have to be innovative, it's just as available in terms of credit creation to go out and to expand.
Yeah, I think so, Lisa. I mean, I think, what we're seeing is that with companies that are strong, they are just getting stronger, and high rates and even, just general geopolitics don't tend to kind of take the wind out of the sails of these types of companies, and they do use almost kind of volatile environments to get even stronger and look for opportunities to expand, pick up, sort of do small. We're seeing a lot of mid-market companies like doing not like big transformative kind of deals, but small bolt-on M&A, like picking up a kind of a $10 million company, $20 million company, adding a particular expertise. Those are some of the things that we're hearing a lot from our clients.
Interesting. Tasnim, let's do this again next time you're in New York City. We'd love to have you with us around the table. Tasnim Ghiawadwala there of Citi. European Investment Bank President Nadia Calvino is here in New York with us for more. President Calvino, good to see you.
Very good to see you.
Great to catch up once again. You're back from Washington, D.C. We are as well, so maybe we can compare notes. We've talked a long time about a lack of cooperation, maybe, worldwide, a breakdown between the United States and what the Europeans need and what Ukraine ultimately wants. Did you sense the same thing at all in Washington? Are we coming together or moving apart?
We're definitely coming together. Indeed, I think it was a very productive spring meetings week. We had many exchanges, and I really see a momentum in coming together and supporting Ukraine very strongly, but also deepening our cooperation within the multilateral development bank family to contribute to climate change financing, peaceful and more, how would I say, sustainable world going forward.
We'll get some more details on your lending plans in just a moment. There has been a sense of fatigue in Congress around what is happening with Ukraine in its war, its fight against Russia. There are some people asking whether there is a different way, whether this should be something we continue with, stick with, continue funding what looks like maybe a never-ending war. What would your view on that argument be?
Well, absolutely. We need to support Ukraine. It is a very serious situation that we're living. It's a threat to democracy at the end of the day, and the way we see things, I think, in the US and Europe too. And so from the European point of view, there's no doubt our support to Ukraine is unwavering. I think the decision that has been taken by the US to provide support for more than $60 billion is very valuable. And this joins also the previous decision of the European institutions to provide $50 50 billion euros in the Ukraine facility, which we will manage at the European Investment Bank. And I think it will provide much valuable support for the reconstruction as well as the military effort, of course.
But President, did you see the vote counts on those aid bills? So when you look at something like the Indo-Pacific, it was 385 to 234 in the House. When it comes to Israel, it was 311 to 112. It barely got through when it came, to Ukraine. Okay. How concerned are you about how deeply divided U.S. politicians are about aiding Ukraine over, say, other issues like Israel and Taiwan?
I really think that we should continue to support Ukraine. As President Zelensky was just saying on the screen, they have a chance if we continue to support them. From the European point of view, Ukraine is our neighbor. It is a prospective member of the family, if I can say it this way. And thus we need to ensure that we keep a secure environment in the region. The other conflicts are just as important. I mean, the Middle East situation is very worrying. It's a source of concern for all of us. And we should try to stop that war and that conflict, as soon as possible. But Ukraine should not be forgotten.
But in the numbers, it shows that Ukraine was the hardest one for lawmakers to get through. What does this mean potentially if you were, say, to deal with a different administration, a Trump administration?
Well, I wouldn't like to speculate on U.S. politics, and I wouldn't dare to comment on the internal wheelings and dealings. But I think the most important news we have today is this got through. More than 60 billion dollars support, and this will provide a very valuable support to Ukraine at a crucial point in the conflict, in the war.
President Calvino, how much is this actually, the uncertainty, helping you to raise money for military efforts within Europe, to bolster military spending within the continent?
Well, it's obvious that, some people woke up to the fact that we were more fragile than maybe we thought because of the war in Ukraine and the unwarranted aggression by Russia. Many member states, the frontline member states, I think, were already wide awake and very aware of the challenge of having this kind of neighbor. But, it is absolutely clear we need to step up and support Europe's security and defense industry. And the European Investment Bank can play a role in that.
When you talk about financing it, how much are you on board with the idea of monetizing Russian assets that are harbored in Europe, maybe in tandem with the United States in terms of coming up with some sort of plan?
It's very important, I think, that we act united, and so the G7 discussions are extremely valuable so that we move ahead as one. Of course, the situation is not comparable between the US and Europe in terms of the volume of assets we are discussing. And on the European side, we are making progress. The European Commission has put forward a step-by-step plan, and so, we're making some progress in making sure that these assets are put to good use in supporting Ukraine.
In supporting Ukraine, does it also include in investing in some of the military development in Europe?
I think this is a bit, too soon to say how is the best use of these assets. Just see that we are really unwavering in our support to the country, and we're making progress in mobilizing all sources of financing to provide that important support.
When it comes to the Russian assets, particularly the ones in Europe, there's lots of different things being thrown around on how to actually monetize it. Do you expect a decision when the leaders meet in June in Puglia?
I certainly think this is going to be on the table. And it is a different issue to talk about the assets than talking about the proceeds coming from those assets. I think there is more unanimity on the second than the former. Many considerations are on the table, and we need to calibrate well our decisions so as to make sure that there are no unwarranted side effects.
I just wanted to wrap things up, President Calvino, with the changes you've proposed to the EIB, which is a plan to ultimately make it easier to fund defence projects. Could you talk to us a little bit about that? What can we expect? Are these changes going to go through?
I certainly think so, yes. For the past 8 years, we've been already financing Europe's security and defense industry. What we are doing now is adapting our lending policy whilst preserving a very strong financing capacity. I mean, the EIB has a AAA plus consideration in the market. We are a very strong player in financial markets. Only last week we had an auction. I was following your program this morning, and it is impressive because last week we did a 5-year bond of 5 billion issuance, which was heavily oversubscribed, around 21 billion euros in demand. And we closed with an interest rate that was just 10 basis points over the US Treasury. So that, shows the important financing capacity of the bank, and this is what allows us to be very competitive in financing our clients, public and private clients, and contributing to growth and prosperity in Europe and beyond. So we really need to calibrate our response as well. So far the market is responding as we had anticipated, and I think we certainly will step up our support to Europe's security and defence industry.
Just a final comment, if we can. You, of course, were part of the Spanish government for a little while. I'm used to calling you minister. I want to get your thoughts on whether the defence spending will overwhelm the capital that could be used for developing the European economy more broadly. Are you concerned about that in any way, shape or form?
Well, certainly. That's why I said a moment ago we need to mobilize all our funding sources so as to make sure that funding our security and defense effort, contributing to peace at the end of the day, is not weakening our support to social infrastructures, innovation, the digitalization, and of course climate action, which is a top priority and the key challenge of our time.
Nadia, it's good to see you. Thanks for dropping by.
Very good. Thank you very much.
Enjoy New York. Nadia Calvino there at the European Investment Bank.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.